In 2020, the most basic human need became a tradable asset. It wasn't headline news, no national debate, but a quiet switch flipped and opened the floodgates for the richest institutions in the world to place their bets on your water supply. California's historic droughts have always been brutal, but what's happening now is different. This isn't just nature, it's finance. Because while entire towns ration tap water, hedge funds and private equity firms are quietly taking control of the one thing no one can live without. In December 2020, while California's reservoirs dried up and entire towns rationed drinking water, a shift occurred, not in the soil but in the spreadsheets. That month, the CME Group, a global commodities exchange, launched trading for a new financial product, the Nasdaq Velas California Water Index Futures. With the flick of a switch, water, humanity's most basic need, was transformed into a financial asset, tracked by price, traded by contract, and speculated on by brokers with zero ties to the land. There was no referendum, no primetime debate, just a silent systems update in the global market. And just like that, the last thing on earth we thought was untouchable became a line item on Wall Street. The announcement raised immediate alarms. The United Nations, through water and human rights expert Pedro Araujo Agudo, issued a warning. "I am very concerned that water is now being treated as gold, oil, and other commodities traded on Wall Street," he said. Some compared the move to a Mad Max scenario, where water no longer flows through rivers, it flows through hedge funds. While the creators of the index insisted that fears were exaggerated, California's own history tells a different story, one full of failed empires and speculative land grabs. As far back as the 1990s, Texas billionaire Bass Brothers attempted a similar maneuver, buying vast tracts of Imperial Valley farmland, just to resell subsidized water to San Diego at a 3,000% markup. Their deal was ultimately blocked by public outcry, but it exposed a simple truth. When water becomes profit, the rules and the priorities begin to change. Supporters of the water futures market maintain that this isn't exploitation, it's protection. According to Lance Coogan, CEO of Velas Water, the idea is to give growers a financial tool to manage uncertainty. Imagine a farmer expecting a brutal drought. They lock in a contract to buy water at $500 per acre foot. If the market price jumps to $560, they sell the contract and use the $60 gain to offset the higher real-world price. If the rains come and water drops to $440, they eat the loss. It's hedging, not hoarding. And in theory, it helps stabilize operations in an increasingly volatile climate. But critics argue the model may be flawed and potentially dangerous. Unlike corn or soybeans, water doesn't behave like a typical commodity. Its use is restricted by an arcane maze of state laws, riparian rights, and historical entitlements that vary from one irrigation district to the next. Ellen Hannock of the Public Policy Institute of California warns, "People have tried to make money off the physical water market in California and lost their shirts," she says. And even if futures contracts remain paper trades, they still reflect real scarcity and incentivize profiting off crisis. As Basav Sen of the Institute for Policy Studies notes, markets might even dull the urgency to adopt better practices. If large agribusinesses can offset their risk with futures, they may have less incentive to reduce water usage or transition to sustainable crops. "Markets solve shortages," said water expert Peter Gleich, "but they don't protect people who don't participate. That includes farm workers, whose jobs vanish when fields go fallow, and the environment, which has no seat at the trading desk. In a market-driven system, only buyers and sellers matter, and the rest are left behind. So while Wall Street sees water as a volatility play, those on the ground see something else entirely. A deepening divide between those who need water to live and those who use it to win." After 2021, the quiet financialization of water in California took a more concrete form. private equity firms, pension-backed real estate funds, and agriculture investors began acquiring vast tracts of farmland in the Central Valley, not to grow food, but to control the water rights attached to the land. In California, access to water often depends not on present need, but on seniority, legal priority that can date back more than a century. That means if you own the right land, you own the right to draw water, even during droughts when others are cut off. And that right can be worth millions. These land purchases weren't driven by agricultural ambitions. In many cases, the land was fallowed or leased out. What mattered was what flowed beneath or beside it. Firms like Farmland LP, Trinitas Partners, and anonymous holding companies funded by institutional investors began collecting property in regions with strong senior rights, effectively cornering access to aquifers and river systems like a slow-motion monopoly. The land became a vessel. The crops didn't matter, the water did. And because California law allows water to be transferred, banked, and sold, this was no longer farming, it was resource extraction disguised as agriculture. To understand why land has become the key to controlling California's water, you have to go back, not to the 1990s, but to the 1800s. California's water law is rooted in two overlapping systems: riparian rights and prior appropriation. Riparian rights were inherited from English common law and give landowners adjacent to rivers the right to use water, as long as it's reasonable. But the real power lies in appropriative rights, born out of the gold rush. Under this system, water rights were granted to whoever claimed them first and put them to beneficial use. It didn't matter if you owned the land. If you got there early and used it, the water was yours. And once recorded, those rights became permanent property, often passed down or sold like titles. What this created was a kind of legal time machine, where 19th century decisions still dictate 21st century access. Today, many of the most senior water rights in California are held by large farms, corporations, and districts that staked claims over 100 years ago. These rights are immune to drought restrictions that affect more junior users. In some cases, they allow holders to draw hundreds of times more water than entire towns. And because these rights are tied to land ownership, buying the land means buying the water, even if the land goes unused. This legal relic, once designed to encourage westward expansion, is now the engine behind a slow-motion resource grab where money doesn't just buy influence, it buys the past. By 2023, the quiet game of water speculation was no longer going unnoticed. Investigations by ProPublica, Bloomberg, and environmental watchdogs revealed that Wall Street firms were acquiring farmland not for food, but for the water rights beneath it. Entire towns rationed tap water while investors transferred and banked water for profit. The optics were brutal, and the political pressure finally cracked open. In March 2022, Senator Elizabeth Warren and Representative Ro Khanna introduced the Future of Water Act, aiming to prohibit futures trading of water and water rights altogether. It wasn't a one-off stunt. Warren had already been aggressively pressuring agencies like the SEC, CFTC, and Treasury Department to regulate climate-linked financial risks. Her warnings stretched back years, from climate risk disclosure rules to insurance company withdrawals to calling out speculation in oil and wheat. She'd been building a case for treating climate threats as systemic financial dangers. By 2024, Warren escalated. Along with Senators Markey, Sanders, Whitehouse, and a growing bloc, she began linking water commodification to a broader pattern of unchecked speculation in essential resources. In April, she led 23 colleagues in urging federal regulators, NASA, DoD, and GSA included, to finalize rules protecting the federal supply chain from climate risk. Just a year earlier, she warned the SEC's climate rule was the bare minimum. Her momentum was clear. The financial system was not just ignoring the climate, it was monetizing it. And now, water, the one element no life survives without, had been swept into that logic. When Warren said, "Water is not a financial instrument, it's a human right," she wasn't just reacting to Wall Street. She was trying to stop an entire paradigm from taking hold. But even as lawmakers push for reform, the damage may already be underway. The market rewards those who can participate, but millions of people and ecosystems can't. As economist Peter Gleich explains, markets are designed to balance supply and demand, but they do nothing for the voiceless. Farm workers lose their jobs when growers sell water instead of planting crops. Small towns face rising utility costs while investors extract profits upstream. And nature itself, wetlands, fish, and migratory birds, has no legal standing in a marketplace that only listens to contracts and capital. When water becomes a financial product, those who simply need it are erased from the equation. The deeper problem isn't just about fairness, it's about power consolidation. Once a hedge fund owns your region's senior water rights, they don't need to drill or irrigate. They can hold, trade, or sell, and reshape entire communities in the process. As environmental economist Ellen Hannock warned, people have tried to make money off California's water before, and many have lost their shirts. But this time, the risk isn't just financial, it's existential. Even if some investors lose, the legal precedents, diverted flows, and lost access may be irreversible. This is Choke Point 2.0, not run by a federal agency, but by a market mechanism. And in this version, the price of survival is set by whoever got there first with enough capital to buy the source. In the end, the question isn't whether water should be traded, but what happens when it is. Supporters of water futures argue they offer predictability in a climate where nothing else is stable. Droughts are getting longer, reservoirs lower. For farmers facing ruin, being able to hedge against rising water prices can be the difference between survival and collapse. These contracts, they say, don't privatize water. They help manage its risk. In a state with a $50 billion agricultural economy, that's no small benefit. But critics say the system creates far more problems than it solves. By turning water into a speculative asset, it invites profit-seeking into a space where people, ecosystems, and local economies have no seat at the table. Farm workers, small towns, and nature itself can't hedge, can't speculate, and can't outbid Wall Street. Worse, it may incentivize scarcity, rewarding those who stockpile, wait, and sell high, while others run dry. As long as water rights remain tied to land ownership and century-old legal claims, the system will keep favoring those with the most capital and the longest memory. So what do we call it? Innovation, exploitation, insurance, a ticking clock? The truth is, California's water is no longer just a natural resource. It's a market. And the market has already decided who gets to buy in and who gets left behind.